is not my usual to be in this kind of a gathering. So a lot of you must be wondering how I come to be here. But I think Terry Ann and the team invited me because I've made a very strong position, a very pronounced position about my views on the issue of interest rate capping. But perhaps for you to understand my position on this, let me be open upfront that I'm a banker. Before I joined politics, I had done 2 decades of banking. Jeremy Gunza is here. He was my peer in banking. I'm not sure whether I will not be his boss if I was still in banking today. And of course, a lot of colleagues in the industry who are my peers, plus some people who have come after us, and of course, outdone us, like my mono in the School of Business in the University of Nairobi, Joshua Igara. So I'm very much part of this industry. My background is in operations, technology, product development. I worked for Standard Chartered with Jeremy here. Moved abroad to work on projects and transformation with some gentlemen who are sitting there, like Mohammed Welia, who is a prolific writer, and now a senior advisor to the Saudi Arabia Monetary Authority, Sama, where I worked with him out there. And that was my history before I joined politics. 2 years ago, in August of 2016, when this debate was up, I was one of the only voices who was against capping of interest rates. And I was in a very awkward position because I sympathized and I supported the reasons which led some of my colleagues, like Honorable Giorgio Moisia, to go for capping of interest rates. It is my view that why we have capping of interest rates today is because of what I would call massive policy failure. That over time, things that should have happened didn't happen. Alternatives, which are policy alternatives, were not carried through and were not seen through. And therefore, the end result is that my colleagues, members of parliament, were of the view that the only panacea for that is to regulate and cap the interest rate. I did argue then, and I wrote in the newspapers, that the disease that we are trying to cure cannot be argued. It was there and it was real. But unfortunately, the solution we were advocating was simple, was direct, but it was wrong. It was wrong because history has shown us that once you liberalize markets, and once you open that door of free markets, trying to come back to that creates far bigger problems than the original problem you're trying to solve. It was my opinion that we have not exhausted, and we had not exhausted by that time, the alternatives that were there to using regulation. And I'll just mention a few. For example, we all know, and we're talking about it everywhere, about the effects of massive dependence of domestic borrowing to finance our budget. And that is the biggest problem we're having. Mwai Kibaki, in 2004, did not cap the interest rates. Yet, we were on single digit. Why? Because he went for the cause-effect relationship about the various options within the macroeconomic management of our economy that was available for him. So he didn't come to Parliament asking us, please cap the interest rate. So what did he do right in 2004 that we cannot be able to do today? Why are we borrowing? Why is government borrowing from banks so heavily in a way that crowds out the private sector, the SME, and the small mwananchi from borrowing? Until we ask ourselves that question, going for capping through legislation actually puts our monetary policy and our monetary mechanisms into a trap. And that is what I argued 2 years ago. Sadly, it is not every time you're happy to be proven right. So in this particular case, I'm very sad that I have been vindicated after 2 years. Actually, all my predictions, the shrinking of the credit, have been proven right. The only one prediction that I was wrong on is that our Tier 2 and Tier 3 banks will collapse. None have collapsed. Well, there's no bank that has collapsed since the actual implementation of capping. And why? Because, again, where they would have collapsed, and maybe it was not bad for them to collapse, but where they would have collapsed, they were saved again by our monetary authorities, by our policy authorities, because where they couldn't lend to Mwananchi, they could lend to government through the treasury bills, which have remained the same. So maybe if the right things are done, we may start to see a correction phase within our banking system. And for those of you who are as old as I am, you'll agree with me that when we start having trouble in banking sector, no one is spared. We saw it in the mid-90s. We saw it, some few years ago. It is not really something, even if you say that we are going to do collection on our markets, it is not something you'd want to see. Confidence is driven away, and people out there, investors, I will not want to know whether it was about small banks, about big banks, about this sector or that sector. The whole confidence level on our economy is going to be affected. So it is something that I wish that reason prevailed at that particular time, but I'm heartened to say that it's never too late. We can still, remove the interest rate capping. We can still let the markets operate, but, and a very big but, and I'm very glad my colleague Henry is here. We have got this running with him from January to December. I'm a member of the budget committee now, in the other parliament and in this parliament, and we know, I feel him, and I feel for him. And we are living in a situation of extreme and acute budget constraints, and our resource base is challenged. That is where we are, and you cannot argue about it. However, there are things that still we can be able to do today. We can implement the Treasury single account, so that banks do not lend money to government that belong to government in the first place. And this is something I really want to take up myself. So Henry, I want to promise you that once we remove the capping, I'm bringing in my own Juljomo to ensure that government only banks with the central bank. So that we give with one hand and we take with the other. Because I don't see why, Oigara here gives to Rotich money that belongs to Rotich, and Rotich says, thank you very much, I'm going to give you 14%. That has to come to an end. That has to come to an end. And we need to actually remove the too much oxygen that is there within for banks to be able to operate, sniff it out a bit, so that at least some discipline and some innovation can be able to be realized. I am also of the view, and I'm glad that Henry has taken the first step on that direction, that when I was a student of economics in high school, we were being taught about OMO. And I'm not talking about OMO the soap. I'm talking about open market operations. And I have not heard of it since the 80s when we were in school. So now that we are amalgamating banks, creating Biashara Bank, a very good thing, creating Development Bank of Kenya by amalgamating all the development banks, a very good thing. I would want to see a situation whereby people working for government, companies working for government, in the infrastructure sector, in the housing sector, in the agricultural sector, they actually do not go to Kenya Commercial Bank for credit. They go to our development finance institution, and they get credit as low as 3 to 4%. And they leave the Wanjikos and the Utienos and the Kiokos to be able to go to Oigara. Because as long as Oigara can get the big customers, he has no incentive and no motivation to be able to relate to the SMEs. So I am supporting the removal of interest rate caps. But by the same breath, I am for very extreme and very bold measures to mitigate, to ensure that banks do not go back to their old ways. And people are asking me, you are supporting the uncapping of interest rate. What guarantee do you have that banks are not going to go back to their old ways? My answer is, I have no guarantee. I cannot depend on the good Christian or Muslim feelings of our banks. Maybe they have none. The only way to ensure that they behave is having very extreme and very firm and very robust policy alternatives, which are implemented with resolve. Because banks will never behave, just like capitalists will never behave, because they are not born or made to behave. They are made to behave, and they are made to behave by having such kind of a situation or an environment which will force them to behave. And Henry, as I finish, I want you to even look further. It is good to have those banks you are amalgamating, but let's also look at, for example, the unclaimed financial assets and the resources in there. Let's look at NSSF. Let's capitalize our development banks with such kind of low-hanging fruits that can be able to provide alternative for especially the infrastructure sector, which I am the vice chair of the infrastructure committee in Parliament. I'm very strong on this particular issue, yeah, and the housing as well, on the agriculture, on irrigation. Let's not just go to China and India and all those other places. Let us just mop up the low-hanging fruits of resources that we have here, so that once we get that basket, that cluster of borrowers off from our banks, then we can be able to access, to help the SMEs and the individuals access credit at affordable rates. I believe it's doable. I believe we can do it. We need to make banks smile and happy by removing the caps. We need to make them cry by mitigating that with very draconian measures in other policy areas. Thank you very much.
Thank you, Mheshimiwa. Members of Parliament present here today, Honorable Moses Kuria and Honorable Jude Jomo, the CEOs of banks present here also, and the Vice Chair, Kam, and all the distinguished panelists, ladies and gentlemen, good evening. I think Moses Kuria has almost said what was in my opening remarks, but I'll try to see if I can say it in a different, different language. First, let me really thank the Strathmore Business School and all of you for inviting us for this interesting debate. I'm very sure with the people present here, we will definitely have a very candid debate on this matter, which I know it is really emotive and also something that has given us some policy challenges that we also feel that it is time for us to sit together. Let's, at least we have had 2 years of caps, and all other years we didn't have caps, so we can have episodes to compare with and see how it has worked. And we should all really come together and agree the way forward. So today, I believe is not a debate where we are going to take position and say who is for interest rate caps, who is not for, because everybody will have a strong argument, I'm very sure. And I know when we were involved in this debate before, everybody's right. In any case, in economics, everything is really, I would say, right, because it is based on your assumption, where you are coming from, what you are holding constant, and what you are not holding constant. So I would like to say, those who are pro-caps or against caps, all of them has a strong reason to believe so. But what is important is what have we chosen as a country to the environment we are operating, or what have we chosen as a policy going forward, which we are living in a liberalized environment. Because, you know, when you control one price, and those who know economics, you have to control other prices also. So to control interest rates without controlling exchange rates or prices of goods, you will definitely have a suboptimal outcome. And that is really why it poses a big policy challenge. During controls, it used to work. Because when those days when the budgets were read, everybody was so curious what will be the price adjustments in most of the commodities. But now we don't talk about that anymore. But that time we had the exchange controls, we have interest rate controls, we had price controls. So they could work. Because if you tell me interest rates will be this today, then I will also adjust the prices commensurate to that adjustment, and also exchange rate. But now we have a situation where exchange rate is liberalized, prices are liberalized, and the price of money is not liberalized. Because interest rate is a price of, just like any commodity. It's just a price of just like any good. So you control the price, just like when we used to have those days price controls. You saw people going with jerrycans looking for fuel, or there is shortage of sugar, there is hoarding. So anything that there is controls, be ready for hoarding or black markets, so to speak. So since today we are talking of one price, I'll concentrate on that, what has happened. So let me again just recall some of the debates, how long it has started. I know in the 90s, indeed interest rates were high, and they still remain high. And there are some things in the economy, either the competitiveness, the competition in the banks may not be efficient. The environment we are operating in has actually provided the outcome that we have, because, the price of money depends on the loanable funds, the funds that we have in the economy to loan, and the demand. So if we don't have also deep savings, if we cannot save like what we see in Southeast Asia, where we save up to 40–50%, don't expect to enjoy lower rates, because the loanable fund will be scarce and the demand will be high. So it also requires for us to lower interest rates, we also have to increase savings, which is something, again, we are working on to deal with that. So we have come a long way on this issue of interest rates. I know in 2000, the same proposition was brought to us under the name Don't the Bill at that time. I think that time we were able to fight it in a way, and it didn't see the light of the day. But I don't know what magic Jude Jomo used this time and managed to get it through. Anyway, we are now in this regime. You must know that I did propose in the budget to really undo what Jude Jomo proposed 2 years ago. And I will give you some of the reasoning behind that. Some of them already Honorable Kuria has said. But recognizing this issue, I remember in 2014, I constituted an interest rate committee to look at this matter, because I knew it was coming. And I did try to look for solutions. As you recall, it was that time that we introduced the Kenya Bankers Reference Rate, what is called KBRR. We did ask banks to develop the APR, and a number of reforms that we were doing. Obviously, reforms take time, and we were caught up by the proposal by Jude Jomo to cap rates before some of these reforms actually could happen. But our approach was really, let's attack the root cause of high interest rates in Kenya, as opposed to second-best solution, which is more of controls. Controls do work, but temporarily, as you fix the structural problems or the root cause. So ours was really a fast-based solution, which is really to look at the costs, the structural problems, that why interest rates are high in the first place, and then find solutions for that. So there are many reasons why interest rates were high. Some of them I've already mentioned in terms of the loanable funds, the structure of our banking system. The high interest rate spread is also associated with many things, operational costs that are high in this country. There are also other financial costs, including cash ratio requirement by the central bank, and a number of them. We looked at all those and we see which ones do we need to address. So we are still staying on that course, despite even the regime that we have now of caps, to continue to address that. And our hope was that if these reforms can move quickly, we will not require really caps, and they will anyway become redundant. But what has happened since 2016, the objective, of course, for capping was that the idea was to reduce the cost of borrowing. That was one intention. The other one was to expand access to financial services. And the other one was to increase the returns on savings as the main objective of that cap. 2 years down the line, what has happened? Whether we have increased lending or access is an issue. And our analysis do point that actually it has had unintended negative consequences. And this was expected anyway. I mean, we have seen what is happening in other economies. You know, Kenya is not the first to have had caps. In fact, when we introduced caps, it's the first time I tried to do some research a bit to find out how many other countries are doing the same. And there were quite a number of countries, but not the caps that we have. The way they use caps is a bit different. But they have also learned a lot of lessons. Some have completely removed them. Others have really, the caps are there in the law, but they are redundant. In other countries, like in Latin America, they were set very high. Now the interest rates are low, single digits, and nobody even applies, but they're in the law, but they are just redundant. So the countries do have caps, but they are not very drastic than the one that we have. In fact, to my best of my knowledge, the cap we have is draconian. It is really drastic, where I say so because ours has a ceiling and a floor. All caps in the world don't have both. Mostly just have a cap or so, because it's used for other purposes like usury, to deal with predatory lending behavior. But ours is quite unique, and that is why it has had even much more negative consequences that ideally caps would have. So, and again, you see, at the time of caps, I think from the analysis that we have, about 53% of credit were actually, 53% of the deposits were actually below the 7% that was the floor. and about 60% of credit were above the 14% when it started. So you can see how the effect it had. Anyway, what do we see now? Of course, the intention of the bill was really to get people get more credit. But what we see is that we don't, a lot of small or medium-sized farms are not actually getting. The data is very clear. It speaks for itself that bank credit to these sectors has actually dried up in some cases. It has hit small banks more than the big banks, because big banks are still able to lend to big borrowers. So you can even see the average lending rates, the average credit has actually increased because of the big lending to big organizations as opposed to the small ones. Banks have also become, ingenious. You'll see them. They have introduced non-interest earning deposits account to avoid this, or they have introduced other levies to compensate for the interest rate income that has come down. So again, it does become defeatist in a way. And this is based on the analysis. This is not, it's good that we had the cap so that we can actually do them work and see, compare. This is based on what has happened in the last 2 years or so. So this sort of now informed us really to make this decision that I think for us to move forward, the economic agenda that we have ahead of us requires a private sector that is active. It has to be able to lend. We are going to rely on the private sector to fund the Big Four agenda. And if we are actually going to talk of Big Four and we have interest rate caps, I think we better just forget about it. It's not going to happen with this type of lending that the lending regime that we have. And that is why you saw in my budget speech, I did indicate that, yes, we are providing resources to Big Four, but we are going to rely on the private sector, PPPs. Somebody has mentioned PPPs here. But if we are talking of PPPs and the private sector, they must get credit. And to get credit, they must access. It's true, yes, it's expensive, but we need to lower by really looking at other means, and that is why it takes me to why we have tried to find other sources of cheap funds. I think Mheshimiwa Kuria said about the Kenya Development Bank we are setting up following amalgamation of some development financial institutions. Our intention there is to see if we can raise cheap funds and on-lend to the private sector. We have also amalgamated all the funds. We had the youth fund, women fund together so that we can create a big biashara fund, again, to lend to SMEs. We are discussing with banks to come up with a SME fund and a national guarantee scheme. All these are designed to address the problem that interest rate cap proposal was actually intended for. And if we do that well, I believe we can get around this problem that we have in high interest rates in Kenya, provide funding to SMEs, jumpstart the economy as we work through the underlying root causes, and we have already started on that. The things, collateral reforms, reforms in the land registry, judicial reforms, supporting the banking sector and the like. This takes time. But for short-term measures, instead of the cap, because we see it's really having an unintended consequence, we are better off doing other things like looking for credit. Even in the housing sector that we are talking, affordable houses, we already registered a new Kenya refinance mortgage company, which is going to mobilize long-term credit for that. So we are doing a package of things that we think we should really help to provide credit to the private sector while we live in a regime where we don't have these caps because it will not be able to move us forward. So I think today really I just wanted to just give these remarks and say, based on what we have seen, the analysis. Many people have done analysis. I've seen analysis from the World Bank, IMF, Central Bank, ourselves, Kenya Bankers Association, they have done theirs. So, and I believe even here, as students, those who are doing research in this area, you must have actually also have some data set to look at this issue. So I think it will be good. It's time now that we all sit together, reason together, see what really do we need to do to get out of this. Our proposal is really to repeal it and do these other things. I have also even prepared a financial market conduct bill to deal with consumer protection issues. There are definitely things in the banking sector that needs to be corrected in terms of consumer protection, in terms of, when how what they call truth in lending, what's happening, is banks actually following some procedures that protects the consumer. So that bill is meant for that, and I would also want maybe another session like this to discuss the market conduct bill. Today, let's just focus on the interest rates debate, but I would also want us to look at the market conduct. I have got numerous comments from all of you, Kenya bankers, including Central Bank, which I think they saw this bill as if we are attacking Central Bank. We are not attacking anybody. So there are many things that really we need to discuss on this matter. So mine is just to say, let's have a sober reflection on this issue. And I was just telling Mheshimiwa over the weekend, I was discussing with some farmer who was very annoyed that banks were not giving him credit. They say he went to the bank and he's been treated badly, unlike before. Then, I told him, part of this problem is really what I proposed in my speech, which is when I explained actually to that person that it is the cabs, what has happened is that the bank is now doing cherry picking. It's picking those who are high credit worthy and leaving behind those who are high risk. And he did understood that simple and said, okay, so that is the solution. Let's get the caps out and move on. So I could begin to see that now it's affecting. And I was really glad to hear, apart from our analysis, I talked to one or two people who actually have not been able to access credit. And I wish we could parade those people to give their own story. I think their story would be powerful, the experience in the bank, what they were getting before. Nowadays, we used to get the unsecured loans based on your salary. Now, banks are not even giving because of all that, the riskiness that is there. So I'm not here also to defend banks. They also have their share of weakness. And they're here to be frank also on this debate. Jude Jomo was fixing also a problem that we have. So we are saying that yes, it may have been a solution, but let it be temporarily. I think 2 years is almost becoming long enough. So at that time, we accepted and say, okay, let's have a temporary as we fix. But now we have seen what has happened, so let's begin to move forward. I don't want to take a lot of time because there is a debate here, especially with our panelists who are also very informed on this matter. And ours, from the Treasury point of view, is that we are cognizant of the problem. We know that the interest rates in Kenya are high. They are not sustainable. They are not the right rates. But our solution is let's look for fast-based solutions as opposed to the solutions that we have put. And in the meantime, let's get the caps out as we provide, solutions through, other mechanisms like what I've mentioned, Kenya Development Bank, Biashara funds, and all these put in place quickly. And I think, and with the structural reforms that will continue. We are even engaging with banks, issues of sharing, operation cost. Why is the operation cost high in Kenya? Fix, share ATMs. I'm glad I launched the other day PesaLink, at least you're sharing. So at least those ones will help reduce the cost and the like. So I just want to say thank you very much for inviting me to give these opening remarks, and I look forward for a very fruitful debate. And I'm very sure we will continue to engage as National Treasury and Central Bank. We should come have these more debates. Let's give you our perspective. Let's listen to other perspective. And I think together, as we reason out and reflect, we should be able to actually come up with a solution and the way forward. And everybody will be on the same wavelength in terms of the understanding of this issue. We were alone when we were trying to fight Jude Jomo. But slowly and slowly, we are getting more support. I hope so. And we hope we should be able to deal with this problem. Thank you very much.
Good evening, ladies and gentlemen. Welcome to an evening of national dialogue. Brought together, the interest rate debate is brought to you by Fanaka TV, that's Kenya's first 24-hour business channel, in collaboration with the Kenya Bankers Association and the Institute of Economic Affairs. The interest rate debate that you will be part of tonight is the first of a series of economic town halls and debates that Fanaka TV is going to have. We plan on having at least 3 to 4 conversations such as this per month, which will roll out from today until the end of the year, and of course, going forward. So we invite you to be part of that conversation. So my name is Terian Chebet. I am the CEO of Fanaka TV, and I will be moderating this conversation tonight. Now, on the 24th of August 2016, President Uhuru Kenyatta signed into law an amendment bill to regulate the maximum interest rates that commercial banks would charge on loans and pay on deposits as well. Now, nearly 2 years on, there's been hue and cry over the adverse impact of that law. A report by the Central Bank of Kenya on the impact of interest rate capping on the Kenyan economy shows that the interest rate capping has first and foremost infringed on the independence of the central bank and complicated the conduct of monetary policy. Now, more importantly, according to the report, micro, small, and medium enterprises, which are the bedrock of our Kenyan economy, are receiving less credit from commercial banks, a situation that has impinged on economic growth and job creation, compelling the government to signal a return to market-driven interest rate setting. Now, of course, on the flip side, there is a pocket of our Kenyan economy that strongly feels that the status quo must remain and that Kenyan banks have been unscrupulous in their lending, making supernormal profits at the expense of the mwananchi. And so the question begs, has interest rate setting truly worked, for the benefit of the borrower and the depositor? What insights can policymakers and banking industry stakeholders who are with us here in the room today draw from the experiences of the last 2 years. We've got, these are just some of the issues that we will be talking about over the next hour or so, and I'd like to now invite up on stage our panelists, starting with the man of the night, Honorable Jude Njomo, and perhaps allow me to say the reason we are here tonight. Karibu up on stage. Let's give Honorable Njomo a warm round of applause. I'd like to also invite Mr. Joshua Oigara, the Group CEO of Kenya Commercial Bank. Let's give him a round of applause as he joins us on stage. John Gashora, Group MD, NIC Bank. We also have with us economists Anzetse Were. She's a development economist. Karibu Sana, please join us on stage. Kwame Owino from the Institute of Economic Affairs and also a research and knowledge partner on Fanaka TV going forward. And Sachin Gudka, who will be representing manufacturers, and he's from the Kenya Association of Manufacturers. Let's give him a warm hand of applause. So we'll just quickly take the podium off. As they do that, I'd like to encourage you to be part of the conversation online. The hashtag is interest rate debate. But even as you do that, please keep your phones on silent or on mute. Can I have the chair, please? All right, thank you so much. Honorable Njomo, I'd like to start off with you. Given the background that we have from both, the banking side, Kenyans as a whole, and I was reading an article that you wrote on the Business Daily, saying this is about the citizenry that we're trying to protect. And to be fair and to be honest, when we listen to, regular Kenyans on the street, specifically maybe the ones who can access secured loans, they say this was the right move. Maybe just to start off this conversation, what did you have in mind when you proposed the bill in Parliament?
Thank you, Terian. In 2006, like you have said before, Banking Amendment Act 2016 was assented to by the President. And the main reason of moving that bill was because the banks were misbehaving. The banks had colluded, and interest rates in Kenya, I think, were the highest in the world. And people were complaining that they want to do business, but they are being charged interest rates of 18% up to even 30%. And it is quite obvious that when you have a business where you're making about 30% profit, you're in a good business. But all the profit that you make is eaten up by interest, because if you're paying 28%, then you're making 2%, that pays for your overheads and everything else. So it did not make sense at all. There were many moves to try and push the interest rates down. Central Bank had also failed its duties in regulating the interest rates that were being charged. And like the CS have said, the introduction of KBRR did not have any effect because they were just marking up on the KBRR. And the whole country was in hue and cry that we cannot be able to do business. Banks are siphoning every profit that we make. Now, to add insult to injury, if you would go through the annual accounts of banks, they were making so much profit so that if you compare with other businesses, if you compare the 10 most profitable organizations in the country, 7 of them would be banks. What does that mean? That we are killing other businesses and making our banks better and more profitable. So the time had come when we had to level the playing ground, where we have to let our wananchi, our business people, our SME owners be able to get loans that are affordable. And like I had said sometimes before, in that old regime, credit was available, but it was not affordable. Now, when the law was passed,
some would say it is, affordable but unavailable.
No, I said it was available, but not affordable.
And now?
Today, the loans are affordable, but not available.
Yes.
So the level playing field has remained. So what is the solution? Is it to open the doors so that the banks can come and exploit our people who have elected us to go to parliament and make rules that will help them do their businesses? Or will it be to look for an alternative solution? Because the loans are not available because of two reasons. One, the government is borrowing too much from local banks.
Yes, and I want us to get into that conversation at some point. But since we have the bankers next to you, and you have accused them of colluding, or earlier colluding before the bill was passed in 2016, I want to get a response from Mr. Gashora to start with.
I think before you go, I was just explaining something.
Yes.
That the loans are not available now for two reasons.
Yes.
The government is borrowing too much. From the banks.
Yes.
So we are competing as wananchi. We are competing with the government on who is to get loan, who is going to get a loan. And of course, the banks will give the first preference to the government because they are certain that the government is going to pay back. So we would ask our government also to limit its borrowing and become more innovative. And I'm happy that the guy who borrows is here.
Honorable Jomo, because it is part of the conversation we're going to have at some point, I'm told John Gashora's microphone is off, so Oigara will take your response.
I just wanted to say the second reason before he fixes his mic. The second reason is because the banks are still together.
They're still colluding.
The banks are still colluding, and they have agreed that they are not going to lend. They are going to cause a credit squeeze so that the government now can come to its side, like it has done, and try to persuade the parliament to remove the interest rate caps. Okay.
Mr. Oigara, are you one of the banks that are colluding?
Well, thank you very much. I think, one thing that we agree, definitely the industry doesn't collude. And I would say two things that one issue that industry agrees with Jude is that interest rates were high. There's no doubt about that. The industry has never said the interest rates were low. And I think what CS Rotich mentioned earlier is that there are structural issues we need to address. I personally don't believe that there's one sweep that addresses the issues we're facing on interest rates. And I think that's what we have a difficulty with the current regulation. There are many steps that the industry is facing that we need to address. So some have been identified before. We need to extend the access in terms of how many customers coming in, using more information. But for banks to collude, I will say that if we look at the pricing regime in the industry before the rate, many of our customers, and I want to go to data that the minister mentioned, only 53% of customers truly were beyond the 14%. There were many customers borrowing below, many customers. And so there couldn't be any collusion. It was what I can call a normal curve. And I think what needs to be done more, and we had what we are welcoming is a conversation happening today to address the specific issues. What I find from our customers that I speak to many times, Terian, which is a big worry, is many customers say they need access to credit today at whatever price. That's what they always say. They have a business to run. And I think banks, people see the numbers because we're regulated and we're among the industry that publishes our results by law. That is a requirement of the Banking Act. There are many businesses that never publish their numbers. If you do, you will see different performance actually that happens. And I think we need to find a way to deal with the high interest rates today rather than dealing with one universal measure to cap every other industry where the credit portfolio risk profile is not addressed. That is the issue that I have a difference with the model. But in terms of the rates, I think the industry agrees very much with Julia. We need to address the issue of interest rates.
All right, and risk is an issue that we're going to touch on our conversation tonight. Just very quickly before I invite an opinion from the Kenya Association of Manufacturers, Honorable Njomo mentioned, that yes, the interest rate is now affordable, but it is unavailable. And he has accused the banks of colluding once again to ensure that SMEs cannot access this, this financing. What's your opinion on that, Mr. Gashora?
To echo what Josh just said, there's no chance that banks can collude. I think we are perhaps the most regulated industry in this country, and will continue to be. And beyond that, I do want to point out that banks actually adhere to regulation, not just in Kenya, but globally, for the fact that we trade with every bank around the world. Yeah? So we are highly regulated, and therefore colluding would be the last thing we would do. I think the fact is that the Cabinet Secretary talked about the variation in lending that you saw at banks. And that even at a cap of 13.5%, there are customers who are borrowing well below that. So it's not that everybody is 13.5%. But also didn't want to point out something that's, that the statistics have shown, that since the cap, between 2016 and 2017, 1.23 million borrowing customers have stopped borrowing. 1.23 million borrowing customers have stopped borrowing. That's a big number. Beyond that, the average loan amount during that time has grown by 47%. What does that tell us? It tells us the rich and the big companies are continuing to borrow. So what Honorable Jomo wanted to help, the SMEs, the individuals, those are actually the ones that are not borrowing in this market. So for me, it is to think about, I think Honorable and ourselves talk about the same language. We want to help SMEs. We want to make it affordable. We want to make it accessible. If we're talking about SMEs, yet the people, the statistics show, are being wiped out of the market, I think we have to come together and talk about how to move to the next stops, to the next steps, some of which Bukuria talked about.
All right, let's get a business standpoint now from Mr. Gutka. How has access to credit been, for the majority of your members at Kenya Association of Manufacturers? And Mr. Gashora did, Oigara, my apologies, alluded to the fact that a number of people were actually already borrowing below 14%. And the feeling is that these are people who are big borrowers who could perhaps fall under your space. So are there smaller enterprises that have not been able to access? Because I guess in that case, the big ones can still negotiate their way around it.
Thank you, Terianne. The KM is made up of actually a majority of the SMEs. And it is true that the big borrowers are borrowing cheaply, and they are borrowing at competitive rates. KM itself, when it financed its own building about three years ago, we got a rate of T-bill, 90-day T-bill plus 3%. So in that time, so it's basically, it is lower than the 14% or 13.5% that we're currently at. So but we were financially strong. The issue is, I asked my board yesterday during the Brazil game on WhatsApp, what are your thoughts? And we have a 17-person board. I would say the answers were pretty much half-half. Half were for retaining the cap, half were for removing it. I would have to come down on the side of removing it, because the access to credit for our SMEs has been really bad. The engine of the economy is the SMEs, the entrepreneurs, and we need them to be able to access credit with which to drive and propel the economy forward. So I would say it has severely stunted their growth projections over the last couple of years. Getting credit, so there's two options. If they want to grow, they will borrow outside the normal banking channels, and they'll borrow at really bad rates, probably in the region of 28 to 36%. And that kind of Shylockian lending is simply not sustainable for a growth economy. Yeah.
On that note of SMEs, I'd like to rope in Anzetse into this conversation. And I know you're passionate about that space, and you've written a number of articles around SMEs and access to credit in this new interest rate regime. Perhaps you could just lend us your thoughts as part of the conversation.
I think broadly, the conversation on interest rate caps is really a conversation about liquidity. And the fact that the majority of the private sector in Kenya, particularly micro, small, and medium enterprise, feel snubbed by the financial sector. That's why it's such an emotive issue, is that we're here, we're doing good business, and yet you guys have these labels that you put on us and you tell us that you're not good enough to get our money. So I think one of the problems with the interest rate cap has been articulated, that it did the opposite. And I was among the first people who were saying that this will lead to a contraction in liquidity, not an expansion. When you start limiting risk ceilings, people get into sort of a very cautious mode, and that's what we've seen. So I think the real concern is that there are two sides of the private sector going on here, as the gentleman alluded to. There are those who are arguing that you must repeal the cap so that we can get the liquidity going again, so that private sector, particularly small and medium enterprise, can get the money. But there are also smaller business players who are saying, no, do not repeal the cap. Because right now, what banks are doing are running to government securities because that's a safe space. But some are arguing that let them run once that saturates, particularly if, as the CS has mentioned, we may go through a phase of fiscal consolidation where we may see a contraction in the amount of borrowing government is going into in the market going forward. If that happens, the smaller players are saying that will saturate and they will have to deal with us. So that is the logic that's going on there as well. I think the other problem that's happening is that this hasn't been going on for long enough for some people. What has happened is that over the past 2 years, over the period of the interest rate cap, the conversation has been primarily driven by the adjustments that banks have been going through, right? In terms of protecting their bottom line and how they're making that happen for them. What we haven't seen, which is my concern, is the extent to which banks are really looking at their risk profiling and their risk modeling to make it more relevant for small and medium enterprise. And I think that's what the conversation Kenyans really want to have is, what is it about micro, small, and medium enterprise that is so risky? And what can both sides of the divide do to bridge that impasse that we're at? Because when you look at small businesses, they're like, whatever we do, they just want collateral. No matter what I try, that is all they want. On the other hand, we have the banks who are saying, listen, your risk profile is something that we're concerned about. So that is the conversation that we need to be having is, if we're not financing 80% of where Kenyans earn a living, then we are neglecting the economy. And until we have that conversation and understand that impasse, then I think, this will continue to be a heated debate that's never resolved.
Kwame, from a think tank, point of view, studying what has happened over the past 2 years, what would your opening statement, vis-a-vis the comments on the panel this evening?
Yeah, I think it's a good thing that we started by, and the Cabinet Secretary mentioned what was the intent of the bill. And Honorable Jomo's mentioned as well what his intentions were. They are also agreed on the fact that it did not have those specific outcomes. So we haven't seen more lending to small and micro enterprises. We haven't seen better rates for savers, and we haven't seen that contraction. So basically, on all the three items for which the rationale for the bill, we haven't achieved that outcome. Now, I think if you start from a legal perspective, laws should not be passed in vain. So let's even start with that. We can leave the economics and the debates aside. Laws should not be passed. So if we pass a law that 2 years later has not achieved what the effect was, we shouldn't say, like, let's dig deeper and wait for it to hurt before we can all do that. It hasn't. On the other side, one of the things that we've done, one of the reasons why it was predictable that wasn't going to happen, government had huge deficits and ongoing deficits. So if I was any banker, and remember that they're also accountable not only to their shareholders, to their boards, it would be responsible to lend to at the risk profile that is risky, when you can actually sweep the floor with these coins the government was throwing at you. So unless, and Honorable Jomo said that one of the things that his government is, you shouldn't be saying that you're pleading with the cabinet secretary to lend less. Just ask him to reduce the deficit. And you can do that as a legislator by saying, look, we are not passing this budget unless you squeeze this deficit. And that's your legitimate responsibility. It's constitutional. So in a way, in the same way that you're pointing at banks and telling them, look, stop your collusion, you can also point at the cabinet secretary and say, we are unhappy with the deficit. So my thinking is, and perhaps members of parliament should do, all the responsibilities that the government of Kenya has, and they're huge, can be accomplished for much less than 2.5 trillion shillings. So what you should tell him is that, look, we want you to trim this budget by this amount. Don't give us an incremental budget, which means that if we gave you 1 year 2.7 trillion, then you expect us that in the next year we are going to necessarily raise it. No. We want to see you achieve greater goals with less money. So by that, definitely the lending from the domestic market and externally would have to be squeezed.
All right. Thank you. With that, I'd like Honorable Njomo to give, just a follow-up to that, the issue of deficit and the issue of interest rate, which will, bring us to the same conclusion that we're looking for.
Well, he has made it look like there's no positive effect of the law. The savers are earning more out of the bill. Because previously, they were earning about 3%. Now they are earning 7.5% because of the flow. So people are earning more. It's very, very unfortunate that there are very few people who save. So those few who save are earning more. Two, I think Bwana Rotich has done well this time because he has tried to reduce the deficit. And it's going to have a great effect on our economy. And there are other measures that he has promised to put in place so that there can be better regulated system in the banking industry. But why do we want to remove the caps before those measures have taken place and we have felt the effect? We have suffered a lot under the banks. Why do we want to suffer one more year as we wait for those measures to be put into place? I have a responsibility, just like you said, I had a responsibility in reducing the deficit. I have a responsibility of protecting the people who elected me to parliament to go and make rules and to do oversight for them. So I still feel, yes, we may have to remove the caps, but the time has not come. Right. I remember the CS said we have waited for long enough, but I don't think Mwananchi have waited for long enough. He has suffered for many, many years. The bank continues saying that Mwananchi is a risky lender. And I wonder why. I was Googling the interest rates that are charged by other African banks. And I was shocked that our sisters in Tanzania are being charged 12.14%. And there is no capping in Tanzania. How comes we are so dangerous, much more dangerous than our brothers and sisters in Tanzania?
And I want the CEOs to directly answer that question. We've got both Gashora and Oigara raising their hands.
Sure, can I?
Yeah.
Yeah, let me please comment on that, because I think the honorable member has mentioned some numbers, and I think we should put the record straight. That first of all, that we do operate in Tanzania as KCB does in Tanzania. So I know the numbers firsthand. I can assure you that Tanzania today, government borrowing, T-bills, are at 2%, 2 to 3% today, okay? That is the truth. In Kenya, we're still 8 to 12%. That's a fact. The second thing I would say is lending to companies in Tanzania shillings, the lowest I have seen so far, and Joshua, maybe you're better than I am, in 17%. So I'm curious where you've gone in the 12% from. He also made a statement before saying lending in Kenya was the most expensive in the world at 28%. Yes, it was very high. 28% was very high. And Joshua alluded to the fact that we as banks recognize this. Part of the reason we have not been able to bring it down as banks is because we cannot collude. You've asked us twice whether we can collude. It's actually because we cannot sit in the same room, Joshua and I, and agree, and Jeremy, and agree that we bring rates down. That's collusion. We cannot do that. However, I can assure you that our customers, most of them today, Kenyan customer is multi-banked. At NIC Bank, 85% of our customers have more than one bank account. In other words, they know my rates, they know Joshua's rates, they know someone else's rates. And when they negotiate for rates, they look at those three banks, or more banks, whatever number of banks they have. The honorable member also talked about the fact that the positive effect of this bill has been that the savers have received better returns. Now, I would agree with him. The savers have received better returns. But who are the savers? It's the people you see on this stage. It's the rich people. Are they the people we're trying to address today? We're talking about the SMEs. We're talking about the small borrowers out there. So whereas there are positives, obviously, to this rate cap law, as we said before, those who are able to access are accessing at a much affordable rate. Unfortunately, it has locked out the majority of the people we want to help. Okay. As I said, 1.23 million accounts have stopped borrowing.
Gareth?
Yes, I think I want to just add one issue that Jude raised. I mean, it's just to make it a conversation, and also what Anseta said earlier. It's important to see the trend. What is the challenge I have with this conversation is that we want to cut it deep today and stop. If you look at the rates before, in 2015, rates were as high as 25%. In fact, when Treasury borrowing was at the all-time high, rates went up. And then rates started coming down from before the rate cap came in. You have to see it as a journey, it's a continuum. I mean, many times I see customers ask me and say, we want to borrow at LIBOR plus 2. So assuming LIBOR is 3%, plus 2 is 5%, they want to borrow as London. I want to borrow as great as UK. I ask my customers, but which market are we? I mean, it's like, I ask them, what is the price of their train ticket in London versus a matatu in Nairobi? Because you're going to benchmark, each market has its own fundamentals. Now, banking, we can say is an art. The price of credit is a science. You need to say, what are the risks you're facing today? And I was raising an issue and said earlier to say, it's not that banks don't lend to SMEs. That's not really the question. I think if you look at the last 10 years, today, 24% of our lending overall is small enterprises. It was 10% 7 years ago. Banks are making, as you build in more data, as you're getting more, because remember, at the end of the day, you're deploying resources into a risk environment. That's what banking does, and the customers expect deposits. So other than banks cannot be reckless to put deposit and savings into money where you can't get returns from. So KBA looks at this issue and says, so I was expecting from the work we are doing with the National Treasury, collateral sharing, single registry, cost for you even just to securitize a document, making it easier, legal fee that we enforce. We were saying by 2020, we are going to see access to SMEs going to 30%, 40%. That's what National Treasury is doing ourselves as an industry. So I would say it's a journey. Now, there's a discomfort today. But I always say to Jude, if you look at savings per capita, which is important to look at data, 3 trillion is our savings in the industry, 30 million customers. If you do a simple math, it means as deposit has got 100 million. How many Kenyans today have 100 million as a savings? And this is what John said earlier, that we need to be able to find out that how do we encourage savings? Without savings, India today is at 38% savings. Malaysia today is at 40%. These are data you can find out from the World Bank. We ourselves are struggling at 11%. Now, without savings, we all struggle. And this is a bigger challenge we need to find out. And then we were looking at the mechanisms either through the agendas we have. So I wanted to say that in the region, and I can put on record on the region, because we are in every country, Kenya still has the lowest interest rates today. Neither Rwanda, neither Uganda, neither Tanzania, neither the difficult country like in South Sudan, neither of them. The only country that we seem to be comparing ourselves now to is South Africa, which is around about 7-8%, and to sometimes 10% in local currency, and Nigeria. So, and those economies have specific parameters. What I will wish to do for our customers, and why we are pushing for this, is not to get away, and perhaps, Teriana, we need to look beyond this. What can be done to deal with the risk if the amendment is made? Because there's no confidence, there's no trust that the banks will do the right thing. Maybe that's what we should discuss and say, what more mechanisms are there to enforce a conduct within the industry, within the sector, that can ensure that customers don't get exploited. Things like usury, that's what perhaps we need to look at, because in my view, I believe that I want to lend to that customer today who, actually, you asked me a very good question about what do we do with our risk model. It's a science, we have models, risk buckets. Because of the pricing cap, many customers can no longer qualify to be able to get credit. So they asked me.
But is there opening,
Yes.
or does that provide a space to have a negotiation or to have a conversation about how the banks actually, measure the risk profile of SMEs?
As shares as that, there's also a notion that is being created that SMEs are not accessing loan. That is what these two bankers have said. And I would like to correct their language and tell them, you say, we are not giving SMEs loan.
Okay. And I would like them to directly respond to that. Are you giving SMEs loans?
Yes. Let me comment on that. First of all, I want to be very clear. Banks make money when they lend. We have no other business.
But you're lending to
We
government.
make money, let me just finish. We make money by lending. So we have the biggest incentive, more than politicians, more than anyone else, to lend to everybody who walks through the door. Because that's how we make money. That's our business. Given that, the money we lend is the depositors' money. These people who are getting those 7% rates of deposit, that's the money we lend. And we have to make sure that they are able to come for that money when they need it. It's available. So we must weigh those risks very carefully. Today's numbers, let me just read some numbers out. If you look at the non-performing loan book today within the banks, it's around 12%. It's around 12%. Okay, that means, in simple terms, for every 100 people you lend, 11 or 12 of them will not repay their loan. Okay, that's the number. If you go down to SMEs, that number goes up a bit more. And if you go down to personal, which means individuals, that number approaches 20%. These are the numbers we're dealing with. So you're telling me that a bank should lend to SMEs with a default rate of, say, 15% and charge 13%. They will not even be able to recover their money that they lent. In other words, when Mheshimiwa comes back for his deposit, I'll not have it because I lent it out and I cannot collect it. Yeah. That is the analysis that we do. And we go through that every single day.
All right. Let's move on a little bit and into the structural issues that need to be redressed, where the cost of credit in Kenya is concerned for it to be reduced. And I want to start with Kwame on this particular issue because there seems to be a common consensus that, yes, there is a problem, specifically where the SMEs are concerned. What are some of the structural issues, that can be used? And as you ponder on that for a minute, I want the bankers to think about some of the solutions that you had proposed in 2016, saying, we'll come together and form an SME fund of, X billion shillings, which hasn't been, which SMEs, would come and get money from at a certain interest rate. But that hasn't happened. So as Kwame responds to that, I will be waiting for response to some of the structural issues.
Okay, Terian, your question, half of the answer comes from what a previous speaker mentioned, which is SMEs might be a global name for a number of institutions, but their risk profile is not the same. So some are more risky than others. If that 100 shillings was to be determined, and Joshua, his colleague, was determining who to give it to, they have to make an analysis about who would I lend this money to and ensure that after every quarter or every month or whatever our contract is, I'd be able to collect that money at the lowest, with the lowest costs. So basically, because they have to do that analysis and splitting, it's clear to them that a business with a track record or one that they've dealt with over time is a far better or stands a far better chance of repaying them than somebody else. Mm-hmm. So when we say that we are trying to push all SMEs to be provided with credit, we are actually asking that the default rates go up and increasing the systemic risk within the banking sector altogether. I think what we must, the gentleman can't say it because it's impolite or impolitic, but it's true. Not every person who comes to knock at the door of a banker deserves to be lent money. And the difficult decision they have to make, given the profile in the country, is to decide which people are more creditworthy than others. Remember, the money that they have is not an unlimited supply. So obviously they have to make and choose here. So when you say that, I think the structural question is, we have too many small firms, Fine, all of them are doing well, but the fact that you actually have to dissect and find out who's deserving of this money and how much should we give them and how much funds are available to us as well to be able to provide. It's not an easy job. But as they said, it's in their interest to lend, because the more they lend, you'd assume that, their incomes would be higher. But that risk, and because that risk has not been assessed, not all the data is available, you don't have the profiles of every business and all that. That's the nature of the banking business all over the world, in the sense that, look, we have to be able to lend to some people. They lend in specific profiles that they understand much better than others. And the effect of that is obviously that comes on. So that's the first. The final point is a structural issue that we have. Look, it's very unfair for us to compare ourselves and say that, look, Nigeria lends at this rate and South Africa lends at this rate. If you look at our inflation, which is partly related to government spending, our inflation is at 7% or thereabouts. So if inflation is already at 7%, it means that when someone lends you 100 shillings and you have to keep it for a year, if you give him back 7 shillings at 7%, which is what everybody assumes, he's given you money for a year for nothing. So unless government can deal with actually making inflation a decent question, shrinking inflation, definitely all these costs are real costs. In the end, a banker has to pay somebody else and do that. So the structural issues on the side of the macroeconomy about inflation rates are things that are in the control of government directly. Yeah. Banks suffer from them, or rather, banks face them or deal with them in terms of the backflow. Okay. So if you're not dealing with that, you can't shrink it beyond what they can. What they can do.
But you have some other just one additional point. You've got small, medium, and micro enterprises that are always put together as SMEs, which I think for me is absolutely not the right way to look at it. Every single customer's got their own profile. But some customers, what has happened is in that bucket, some micro enterprises are no longer getting credit. So what we need to do, and this is what I like what the CS has proposed, is an element to deal with a guarantee program, because sometimes it's not really the question about how much the risk. How do you share the risk? It's just sharing model. And Terian, in this case, what we've seen in most markets, even what we thought about as an industry in the Inuka Fund we are setting up, is a partial guarantee program in terms of developing a competency to help. Because even a small enterprise, if I start today, Terian, and one of my biggest challenges I have with when I meet with young students, they say, I want to start a business today and become like come senior member tomorrow. It takes time to build competency, to know your customer profile, deal with relationship, and that's what Inuka Fund was, a program we were targeting 1%. Now, that was just before the cap, 1% of our total portfolio, which was, at that time, it was $30 billion. So it was 1% of that. But then the interest rate came in, and we were not able to roll it out. But I would say that, and it's good for facts to be given, we see a number of SMEs still getting credit, even today, largely because they have matured in their profile, their risk criteria has been much less, and they're growing. You see some of them in transport sector. Some of them were unfortunately affected because they delivered products to government. You see a lot of banks auctioning trucks. John and I, we've auctioned trucks all the time, vehicles. They were good customers. They delivered their goods. No one paid them. And that also became a complication after the interest rates came in. So I would say, Terian, that for us, if that program runs, which we still have in place actually, so the banks have said, despite the interest rate coming, we still want to implement it. And that's something that John and the entire industry is progressing to make sure it is applicable, effective. So that will have reached almost 400 billion shillings, which is a significant amount for those enterprises.
Absolutely. And that's it?
I think the broader conversation that we are not talking about is that what the banks are talking about is that they don't really have a pipeline of credible micro, small, and medium enterprises to which they can lend. And I think that's what's missing in this whole conversation. So the gentleman MP has made the point that a lot of micro, small, and medium enterprises are viewed as high risk, etc. What we're not solving is the step before, which is what is the type of financing that needs to be quite creative. And the other problem I have with this conversation is that it's as though all the micro, small enterprises need is money. There's a whole ecosystem and deployment of support that they require to reach a stage to graduate and graduate into a pipeline. So I think one of the things that we need to do is do the initiatives such as the CS says, whereas government has to play a fundamental role in creating an environment that allows that pipeline to develop. So you have a role of government financing to come in at below market rate to help them. And not only that, you need an ecosystem of support, but you can also bring in development finance institutions, you can bring in impact investments. What I'm not seeing is people solving the problem of how do we get a bouquet of services to micro, small, and medium enterprise at different phases, because as we know, we're not lumping them all together. What type of financing do they need, and how do we graduate them into debt? Because this is the conversation people are not having, is that there are a lot of people who are running businesses in the informal economy, particularly the micro space, that are not necessarily ready for debt. And we need to start getting people graduating into that process. So if we don't have that conversation, people talk about risk profile until the cows come home.
All right. Bashara?
Just to add to what she said, and maybe to counter what she said, actually. KBA spent a lot of time during the debate, in the earlier phase of this debate, talking about exactly those things you talked about, which is, what is it that SMEs actually need to access, and to access credit? And what we concluded is exactly what you said. It's not just the money, there's a lot more. And I think you asked us about what we proposed. Beyond the 30 billion that we proposed to lend at subsidized rates to SMEs, we set up a fund, or we proposed a fund that would be used to educate, to support these SMEs towards getting them ready to talk to banks, because sometimes they actually don't even have the capacity to talk to banks. So we actually have a program, the Inuka Trust, the Inuka Fund, whose sole purpose is to educate, support these micro and SME companies to get to a level where they can approach a bank, be bankable. And once they become bankable, then they can come to the table to talk about interest rates, and we're willing to negotiate on that basis.
All right. Mr. Gutka?
I think when players in industry start behaving badly, a sledgehammer approach is needed. It happened through your legislation, because the delta between the deposit rate and the lending rate was just unconscionably high. And this is simply not sustainable for us to develop as an economy. And I think the banks kept getting signals after signals after signals from government, do something, and they didn't. So the sledgehammer approach was used. It has probably served its purpose. The second issue which Joshua talked about was prompt payment. This is a disease. Government pays late, private sector pays each other late. We've just gotten into the culture of paying late. And the retailers, again, need some sort of sledgehammer approach, because they have driven payments in this sector, which has had a vicious effect across the industry, and it's led to increased working capital requirements and led to increased cost ultimately to the final consumer. In Asia, in 2002, there was something called the Efficient Consumer Response Mechanism was set up. And KM is looking to spearhead this with a view to bringing in manufacturers, supply chain, and players in the private sector working in a concerted manner to ultimately say, how can we bring the cost of goods down by, say, 25% over a 5 or 6 year period? You work on your competitiveness issues, you drive it down, and you do it in a proper manner. And I think the banking sector probably also needs to do this, because 14% for us, is this something that's sustainable for us to really grow the economy and achieve the Big Four agenda within the 4 year period? When Ajomo is saying, let's wait a year, if we're to deliver the Big Four agenda, I think waiting a year is not going to drive the propulsion of lending into the sector and the activities to take off. So is something needed now? I guess it is, to spearhead the revival of lending to sectors.
All right, I'd like to, I mentioned earlier that this would be...
Just like an issue for you, which is, I think it's important for viewers to see. In many times, what the Senator said is actually right, that banks, we need to expand. So industry is looking at expanding the different sources of financing for businesses. Because banks always take the blunt today and say, you're the only one. But largely, even as we are working with the capital markets, the National Treasury, the seed funds coming in from venture capitalists into the market, because that's how you actually put their business coming to the bank today, that if you give them debt, they will fail tomorrow. You see that a lot of times. Now, a lot of if you look at private equity here, most of the funds is coming from South Africa. And I like what Jude raised and what the Member of Parliament raised earlier. Pension funds, like in South Africa, are large investors in private equity in our markets here. But we don't get a chance to deploy those resources to bring in long-term low-cost funds into the market of financing in like SMEs. We never do it. What do pension funds do? Actually, the trustees are very nervous to take a risk on a business. If you ask a trustee to lend to a small business, they wouldn't be able to do it. And I think we need a mismatch of the two. So that's why I like the collaborative. So the time is right to bring in Jude, to bring in the minister and everybody else, to have win-win solution. That's, for me, is the debate we need to be having, because one way or one streak or mark won't be able to address our fundamental problem, even with a cap.
All right.
Terian, I'm amazed at how our banks now have become, very good advisors on Kenyan economy, and they are doing very well at that. But when we were doing this law, they had refused to come and give their views to the committees that were involved. We had to write to the Kenya Bankers Association for them to come and give us their contribution. And I am sure if you go and check out, in that one year, in the second year of when the rates were capped, you look at the profitability of the banks, what they made, and they all made an increment. It may be a small increment, but the increment was there. And remember, it was an election year, there was political turmoil, but they continued to make profit. So all this sugar-coated advice we are getting about economy.
Sugar-coated. Let's give them a right of reply. Gashora, let's start with you.
I would like to believe that this debate was never about bank profitability. I like to believe that we talked about the interest rate cap, again, in the interest of the borrower, in the interest of the depositor, never the interest of reducing bank profitability. I came on record then, and I think you actually interviewed me then in your previous position, where I said very clearly that banks will continue to make profits. That's what I said then. I'll say it again. Banks will continue to make profits. We're in the business. Like every business, you adjust with the times. So it should never be. I think we should take away that debate of bank profitability. But on that, I would like to say this. No country ever developed without strong banking institutions. If you're looking to get to Vision 2030, one area we must focus on is making sure that we have a very strong financial system, very strong banking systems. If you look at America, the history of the Lehman Brothers, the history of JP Morgan, if you look at Europe, the history of the Rothschild and what they did for those countries, that is what develops a nation. So let us not be afraid to have big banks. That should not be the problem. Let's be more afraid to have big banks that are lending only to the government because of a rate cap.
All right. I'd like to rope in members of...
It's important to appreciate the industry. And I will say one thing for them. Actually, you've got a sector that has got the knowledge and the capability to deliver credit to customers who qualify. It's just like a manufacturer. I mean, there is no other person today that will know how to deliver credit today, globally, than a financial institution. I can guarantee you. We don't challenge them. The question is, how do we enable them to be able to deliver with other mechanisms? This is what we really miss today. But to say that banks don't know, I'm not sure there's another person today that has got the metrics, the models, the abilities to be able to do it, not just in Kenya, by the way, globally.
All right, allow me. I did say this is going to be a dialogue, and if we do not allow our audience, then I'll have to change my intro altogether. Japheth Ogutu, you have a question. Please stand up and introduce yourself and direct your question to whichever member of the panel that you want to speak with.
Thank you very much. My name is Japheth Ogutu.
Do you have a microphone, please? Please hold on.
Thank you very much once again. My name is Japheth Ogutu. I'm the Executive Director at the Consumer Downtown Association. Consumer Downtown Association is one of the consumer protection organizations in the country. We stand in for the interests of consumers in the country. And I'm very grateful to be here because there are very important issues that we needed to actually discuss with banks. One, I will begin by saying that what really motivates consumer actually to operate a bank account or with a bank? There are very key issues. One, I would want to save perhaps to get some income later, or interest later, or rather some profit. I would also want to operate an account with bank, for instance, to access loan, or maybe to get some other services like mortgage and other attractive products that are available. But again, we see that really not coming out in the today's Kenya. The interest rates that were capped in 2016, September, a lot have been blamed on the capping. And I would want to point out a few areas. One, the banks actually haven't addressed ethical issues within banks. I would want to point out this very strongly because we are actually turning out the debate to the capping interest rate. We are blaming every frustration that the banks are encountering today on interest rate, when in the real sense, there are also other issues that banks have to deal with.
Mr. Ogutu, I would like to ask you to just shorten it as fast as possible.
Yeah, in short, let banks address the ethical issues.
Yes.
In the banks. The case of Chase Bank, directors looting customers' money.
All right, thank you so much.
It is not the case of capping.
Thank you, Japhet. I think we have it now. We're addressing the issue of ethics
and lastly,
with the banks.
Just 1 minute. Lastly, we actually are for the capping. And
consumers
of course,
are for the capping.
Yeah, but I'm not saying that we will fully support this. There must be very clear measures to ensure we first tame the behavior of banks. I want to reiterate and
right,
what Mheshimiwa said. Let us have the measures first.
Yes.
Then once we have the measures that we are sure that we are not going to be looted, then we can now transit into banking, into the capping.
All right, I guess an issue of trust where banks is concerned, and how do we believe that even if this interest rate cap is lifted, that you will, behave in a manner which, Kenyans would want you to. Do we have another question?
Sorry, Terry-Ann.
Yes, please.
I have a suggestion that perhaps the banks could have a 5 or 6 layer reporting of interest rates across various risk profiles submitted to CBK. It acts like a tracker or a dashboard, and including the cost of all extra charges, et cetera, et cetera. So you get an all-inclusive rate, which is then measured and tracked by CBK to prevent the predatory behavior that had happened in the past. So that could be a mitigation measure that could take place. Yeah.
All right. Does somebody have a microphone?
I do have the microphone. My name is Irene Gadieka, and just your view, 52% of the market share in Kenya is held by the 6 big banks, which means that consumers don't really have room for competition in terms of pricing or going to borrow loans. It's almost like it's very similar. If you go from one of the 6 banks, you don't expect much of a variation. Now, given that we have 42 banks, you would expect the rates to be just as diverse, but they're really not. So your view on that, and perhaps how we are not doing away with the 42 banks, so maybe we could use them to our advantage. How can we address that differently? Thank you.
Thank you, Irene. I thought of one word again that Honorable Jomo did use initially, to say collude, which I do not want to use.
Okay. Okay.
Oigara?
It's okay. There's always been. I can only answer it differently from what you say. I don't know any sector outside insurance that have got many competitors like the financial sector. There are many sectors where there are 2 players. Nobody talks about collusion. To bring in 42 people together in one room to have a conversation, I don't know how practical that is going to be. But all I would say is that I personally go for the industry. There is an element that the regulator, central bank, has been driving around consolidation. What the minister is actually doing today, bringing like-minded institutions. I give you some data and you can read. Look at the United Kingdom. The top 4 banks are 60% of the market. over 120 years. And they've done a lot of surveys. I give you data, which is done actually by the prudential regulator in the UK. Normal, and if you look at it in the last 100 million accounts, less than 1% have shifted in the last 10 years. And prices are known. Prices are known. So it's not just more people you need and to be able to change the price of credit. I think it's about making a customer able, providing a bankable proposal, because remember, not every customer of the bank is borrowing today. We have 30 million customers, 10 million are borrowing. So you also have to look at that element that every borrowing decision is very different when you need it. And I would say that we haven't seen an element of collusion. If that was the case, both the competition authority and the banks, there is a report done by the competition authority for sure. You can to look at it, Terian. It has been done twice. The National Treasury looked at this. And if there was an issue of collusion, the banks could have been sanctioned by today by both regulators.
All right. We've got a question from a gentleman who I'm quite surprised is here because I know there's a football match he should be following somewhere. Mr. Willie.
Sorry, can I,
yes.
Before he asks,
okay.
Can I just comment on Javed's question?
Yes.
Because I think it
The
was also
ethics.
borrowed by Sachin.
Yeah.
Which is that to say that since the fall of Chase and also Imperial Bank, the issue of ethics has occupied our minds quite a bit, both at the KBA level and as individual banks. It's actually a very good point that you raise. So what we did, we developed a code of ethics that the banks have signed up to that talks to a number of things. One is disclosure, which the cost of credit being one of them. Today, we list our cost of credit for every bank, and it's accessible to the public. There's a website. Number 2 is treating our customers fairly. Number 3 is how we handle customer complaints. That is well monitored, and in fact, there are certain punishment for banks that do not handle them properly. And number 4 is ensuring that customers are given the option to move from a bank to bank. So we've lowered the cost of closing an account from each bank to go to another. So we've done a number of things that try to address the ethical question that you raise.
All right.
Yes, forgotten to mention that banks have also, formally, you will not get a seat in the bank. At least today, there are some seats you can sit down on.
I think Terian, she made a very valid point. Why is pricing not so different amongst the 42? It takes a lot of money to move from one bank to another. The cost of a debenture is very, very high. We have the Movable Security Rights, Property Security Rights Act. We need to operationalize it because it creates what we call an electronic collateralized system, and that means everyone's collateral is held electronically. It makes it easier for people to move between banks. If there is genuine competition between banks, I want to move. Otherwise, the cost of moving, including legal fees, stamp duties, and so on, can come close to 4% of the amount. 4% if you're borrowing 500 million shillings, you're looking at a 20 million shilling cost to the customer. So if we start lowering the cost of doing business within the economy, which is part of this efficient consumer response mechanism, we can actually make quite a lot of and bring the cost of borrowing down as well.
All right. Mohammed?
Sorry, mine is not a question, it's just a comment. I don't think the bank has probably defended themselves well. First, I'd like to thank Mr. Jomo. I was one of the first persons to respond to the interest rate capping. And he took a whole page to respond to my, basically, I was against the interest rate capping. I think one of the problems we have, I've been a banker for 20 years, and I've worked in 3 or 4 different jurisdictions. And the problem always is, yes, we know that the interest rates in Kenya are high, but what makes people react to it very painfully is the fact that a lot of the times the banks report big profits. But what people don't understand is that banking is a different industry altogether. It's a different animal from all other businesses, in the sense that if you look at the bank profits, they don't all end up in the shareholder's pocket. Banks, I'm now a regulator. I've also been regulated, and I was a regulator before I was regulated. So if you look at the requirements that banks are subject to in terms of, for example, capital requirements, they're huge. Now, banking industry is very important to any economy, and the financial stability of the banks is very, very important. The only source of capital our banks have in Kenya today is retained earnings. If you go to the balance sheet of all the banks, you'll find that a lot of the retained earnings, a lot of the capital that is required by the central bank is coming from profits. Our capital market is not very liquid, it's not very deep. Therefore, if our banks don't actually make super profit, then we will end up having financial instability. And banks need capital to lend. That is the problem. So if you don't give profit, if the banks don't make good profit, they don't have enough capital. If they don't have enough capital, then they are not able to lend. It's a basic, logic. The second thing I'd like to say is about the cap. I know there's a lot of debate, and I think, as Henry said, he has put measures to try and remove it, but also he's put measures to try and appease those basically who feel that it should not go. And my worry about this is the way it is going to be done. The proposal to establish a financial conduct authority is also going to be counterproductive, in my view. And this is because this authority is going to basically do certain things which will impact on monetary policy. It's going to, credit issues impact on monetary policy. Now you're going to set up another entity which is basically going to deal with credit issues that will impact on what the central bank is doing. And that's why the central bank is very, very angry. I don't want to go into that, but my advice to the CS is, in trying to resolve one problem, please do not create another problem. I have a problem with the interest rate cap. One, it should not be there. Two, it's poorly designed. A lot of us are talking about the fact that it's there. We should be talking about the design. Even if we had a different interest rate cap, maybe. The big problem is it's tied on or linked to the monetary policy tool, which is CBR.
Yes.
By now, even when inflation went down to 4%, maybe we would have lower interest lending rates, but we can't have that because of the way the cap is designed. Because for you to basically stimulate credit, you've got to lower the CBR. Now, if you lower the CBR now with the cap, what does that mean? It means banks will even lend less to the economy. So I think it's a good debate to have.
Right.
It's something that has been discussed a lot. But what Jude Jomo and Moses Kuria need to deal with is the structural problems that we have. And I think that is something that we need to discuss now. And one of the basic things, for example, is that we don't have home addresses in Kenya. Someone comes from Wajir, comes to Nairobi, and then goes to Joshua and says, I want to borrow money from you. He doesn't even have a home address. So some of those basic things then filter or are basically prized by banks as credit risk.
Right.
So we need to resolve those issues. We need to resolve issues, for example, where I have some few banks basically lending money against the same land. We have judiciary issues. We have issues of security. So credit risk is, banks actually prize risk. Sorry, I've taken a lot of time. The final thing I want to say, is the question of why banks seem to be colluding. The banks are not colluding. That's not actually what happens. If you look at pricing, the problem is that very few banks are able to price. The others follow. And it is the same globally. If you look at LIBOR, you look at the panel, then that is, they're followers, and then they're basically leaders. Thank you very much.
Thank you so much. With that, I'd like to have a very quick comment as a way forward from all our panelists. Where to now? let's start with you, Kwame.
Okay, I think we've come full circle in the sense that we tried to solve a problem, we've come back. I concede, yes, that there's more, I mean, if you're saving, then you obviously have more, I mean, you have a greater return on your saving than you'd have had before. But the two other things that are important, pushing out credit, specifically to SMEs, has not happened, or at least it's not satisfactory. So it's clear to me that we actually can ask ourselves, if there's a structural issue, we think there's insufficient competition within banking, and I'm not too sure there isn't, then maybe what we need to ask ourselves is this law the way to where we want it to go to? It certainly is not. I think also we must avoid the idea that we must give in something, or rather we must look like we are punishing banks to make sure that the cap is reduced. I am persuaded that there's an element, there's a lot that the government can actually do, quote unquote, to make banks not have to go for the lowest hanging fruit.
All right.
And to be more innovative in the way that they lend.
All right, thank you. And Zetse?
I just think, obviously, for me, the real issue is the micro, small, and medium enterprise, and really getting an ecosystem of support to help them graduate into debt. I think that's the first thing. I think the other thing is looking at the fiscal deficit and looking at fiscal policy and really getting into a phase of fiscal consolidation, so that we are working together. Government is doing its bit, banks are doing its bit, but we're also working with the micro, small, and medium enterprises so they don't feel as neglected as they have been. So I think until that is resolved, this push and pull will continue.
All right. Ogara?
Yes, first, I must appreciate that we have a broad conversation. So obviously, Moses Kuria, who raised this conversation, and Jude, I think it's important. This wasn't actually happening even at the time the cap came in. Banks had many proposals, but you know, I think Jude was around. We never got a chance to have this engagement. So it's a broader conversation which we need to have ourselves. And my view is that as long as we see the sign of where the direction of in terms of the issues we are dealing with, and some of them are looking at the 12-point actions that the minister had in 2016 on addressing the cost of credit. Most of them are actually being put in place. It's just that they were overtaken by the interest rate cap. And lastly, we have to completely isolate the policy rate, the CBR rate, as a basis of writing credit. It has absolutely no relationship at all. And that has been, I said earlier what Mohamed said, that today, banks could be lending today at 7%. Could be lending today. But they could not be able to do it today because we are locked into a monetary policy instrument. I mean, that's an issue that even in this amendment, even if we get nothing else, that needs to be revisited to allow banks to price themselves based on different instruments for the cost of credit.
All right, thank you. Jude?
I would like to allay fears that we as legislators did this to punish the banks. That was very far from our mind. And what we had in mind was to have an industry that is disciplined, an industry that in itself is also not punishing our people. We may not have achieved 100%, but I think it is very, very important for any industry to take into consideration our low-income earners. Because I believe for us to be able to move forward, for us to achieve the developments that we intend to, we must first and foremost think about Wanjiku. Think about the voter who brought us to parliament. He may not have much in terms of finances, but he pays his tax. And he expects that we are also going to take care of him. I would like to thank the CS Treasury because he has put some measures in place that may help to bring some discipline. Mohammed there said that he's very much against it. You know, banks don't want any regulation. They would like to stay in an environment where they are just doing what they want. But I think the regulations are good because if banks had run amok, the interest had run wild, and there were regulations, what would happen if we did not have a regulator?
Right.
Or what would happen when we have a regulator who is sleeping on the job? They will reap everything from their customers. So I would say yes, we need those measures to be put in place. But I think before we remove the caps, it is better we have the measures first put in place, we see that they are working, then we remove the caps. Finally, because this has to go through the National Assembly, and I have talked to many members, and they are not convinced yet that we have reached a stage where we can let the banks or let the market to control the interest rates, because we still believe that there are other forces apart from market forces that are controlling these interest rates. Secondly, the banks will have shown some goodwill and implement some of the proposals that they had put in place. They have said that they had put 1% of their loan portfolio to be loaned to SMEs. And we listened to them. But when we listened further, the kind of requirements that would be put in place for you to accept that 1% of their loan was keeping off 80% of the SMEs. So it was an exercise in futility. So we thought it is a little too late, too little and too late. And that's why we were not able to buy that proposal from the banks. Right. So we are still not convinced that the time has come to change this law and remove the interest cap rates.
All right. And some people say the other reason is that members of parliament are also some of the biggest borrowers who can access credit at such rates.
Everybody borrows.
All right. Mr. Gashora?
I think it's very clear that there was a very good basis for which this law came from. The emotions, the fact that the banks had misbehaved, the banks were not listening to their customers. And I think hopefully everybody recognizes that the banks have recognized their mistakes, and we are aware of why this law was supported so broadly. What is also clear is that even though we seem to be arguing on this panel, there is full agreement that at the end of the day, we all want to address that borrower, that SME. Honorable Jude Jomo has talked about his voters, his SMEs, his Wanjikos, and those are the people that he wants to support. Those are the same people that we want to support. Given the conversation we have had and the two presentations prior from Honorable Kuri and also from the Cabinet Secretary, it's clear that the sledgehammer, as my friend called it, has not worked for those SMEs for whose interest we are debating. If it hasn't worked, we can either wait to continue having the sledgehammer, squeezing the neck of the SMEs in the hope that we'll get the right time for them to breathe, or we can stop squeezing their necks today, have them at least get the chance to start breathing, even as we bring the water and the food for them to eat.
All right.
My personal view is that the things that the CS talked about that we've been working on have been in process for many years, and they'll continue to be. It's not something that will be done tomorrow, next year. It's a process, and given it's a process whose end we cannot wait for, because by the time we get to that end, there'll be no SMEs to talk about. Right. Let's lift the rate cap.
Thank you so much. Mr. Gupta?
I think the importance of injecting velocity and liquidity into the economy cannot be understated. So this economy needs the lubrication, needs the liquidity injected quickly for us to reach the ambitious targets set. I think Joshua mentioned about the UK banking system. There are probably 10 to 15 million mortgage holders in the UK, or mortgage accounts. We have less than 35,000 mortgage accounts in Kenya. Absolutely pitiful. And the reason for that is they're told 15% interest and a 10-year tenure to repay. In the UK, it's a 25-year repayment period, and obviously the GBP LIBOR rates plus whatever percent. So that, with the affordable housing pillar coming up and so on, it's very important we catalyze the mortgage sector. The banking sector needs to up its game and start being innovative in this segment, and we create a whole generation of homeowners, which will also propel a lot of the growth in the economy.
All right.
Okay?
All right. Thank you so much.
Terian, because...
if you will keep it very short.
Yeah, very, very short. Okay. We have been talking so much about SMEs, and I know that SMEs are coming together because they have found that with numbers they can be able to negotiate. And I know there are efforts right now going on which is bringing SMEs together so that they can go and look for a bank that is going to be sensitive to their needs. And I know that is going to happen.
All right. Thank you so much. And with that, we must...
TS is also put in a good initiative to create the Biashara Bank, which will hopefully result in single-digit lending to SMEs. And I think there's also some guarantee fund that will also come into place. So there are some good innovations coming about, and I think we'll support that.
All right. Thank you so much, ladies and gentlemen. And with that, we've come to the end of our interest rate debate tonight. My sincere gratitude goes to the Honorable Cabinet Secretary, National Treasury, Mr. Henry Rotich. Thank you so much for making time to be with us tonight. Honorable Moses Kuria, Honorable Jude Njomo, Joshua Igara, KCB, John Gashora of CBA, Sachin Gudka of Kenya Association of Manufacturers. And what did I say? John Gashora of, and that's my bank, John Gashora of NIC Bank, Anzesewere, Development Economist, and Kwame Oweno, CEO of the Institute of Economic Affairs. Many thanks as well to the Strathmore Business School, which graciously agreed to host a truly informative and engaging discussion around interest rates capping. To all our viewers here and at home, thank you so much for being part of this conversation. And this conversation continues online on Fanaka Digital and the Kenya Bankers handle as well. Well, let's meet again at the next debate, only on Fanaka TV, and we say we are strictly business. Have a good night.